Hi, everyone. I'm back, and we're going to be having a conversation about ESG, environmental social governance investing, and impact investing, and sort of the challenges we're seeing in the market around impact washing and really ensuring results. So a lot of people talk about mobilizing more private capital. How can you get private capital markets to spend money in a way that can help development challenges? And part of the challenge is that it's hard to verify things that are happening. It's hard to verify claims, et cetera. So to join me in having this conversation, I'm going to welcome Phyllis Costanza, who is the Principal and Chief Social Investment Officer at Advanced Portfolio Management, and Greg Spencer, who is the CEO and co-founder of the Common Good Marketplace. Welcome. So Phyllis, I'm hoping that to kick us off, you can sort of give us a little bit of a state of play. There are a lot of questions swirling about the ESG industry. You hear a lot of things in the headlines. Is ESG dead? What's the next iteration of ESG, et cetera? Give us a little bit of a sort of 101. Where do things stand right now?
So ESG, you mean woke capitalism, impact washing, greenwashing, cause washing, irresponsible investing, go woke, go broke. That's what you mean, right? I do think that rumors of its death have been greatly exaggerated. We are on track to hit, I think it's $34 trillion in assets under management in ESG by 2026. That's only 2 years away. That is a huge amount of money moving to things that we hope are responsible. So what is ESG? I'm sure many of you in this room know the E is environment, S is social, G is governance. And if we look at what we're trying to gather from ESG investing, it's really three things. Number one, what is the risk that has the greatest potential to have a very material financial impact on the performance? So a risk could be, for example, if you're Target, if you have child or forced labor in your supply chain, that is a huge risk for your financial performance, never mind the social negative impact of that. And then risk mitigation strategy around that would be, okay, do they have good policies in place to manage that? Are they doing sufficient due diligence on their supply chain? And that's what we look at for risk management. And then opportunities is the one that we really don't have a handle on yet. And opportunities are, what is the social and environmental positive externalities that this company can bring to society? So I'll give you one quick example, and Greg is going to talk a lot more about the opportunity side of it. But if we think about DE&I, we know that it's good to have diversity in a boardroom. There's been a ton of studies that show that it's positive both socially and it's positive for both performance of a company. But there's other issues where we're not so sure. So for example, if you look at disparity between CEO and the rest of the staff, you know, our basic instinct will tell us like, that doesn't sound good if there's a big disparity in pay. But the reality is, if you're looking just at financial performance, the bigger the disparity, the better the financial performance. So there isn't always a correlation based on what our bias tells us there ought to be and what there is. So that opportunity piece is really, really poorly defined as of now.
Yeah. So we've heard about some of the challenges that exist. I'm curious what you see as some of the potential solutions. How are we identifying some of these challenges? How do you then create the right solutions for them? So we're talking about risk analysis. I think one of the challenges is that right now we have a lot of measurement systems. Most big corporations do sustainability reporting. How reliable is that reporting, right? So how do you start to improve the reliability of data, the transparency of data, the comparability of data, so you can actually begin to understand which company is actually doing better and then identify the opportunities?
Yeah, so I mean the opportunity and the comparability, I think, is one that I really want to point out. So there's something called the impact weighted accounts that was launched by Sir Ronald Cohen, incubated at Harvard, but it's taking kind of a financial perspective to social and environmental impacts and actually valuing those externalities and comparing them with traditional financial statements. So you kind of get a net value across the spectrum of social, environmental, and economic. And that lets you compare different organizations in kind of a holistic sense of the value that they're delivering. And so I think that to me is the future of ESG, where you can better compare, Coke and Pepsi in terms of the net value that they're creating. But I think there's also a unique opportunity from a development perspective, from impact organizations to actually participate in that. So I think impact weighted accounts is something that's I'm really encouraged about, and they've released a lot of new value factors and measures to compare that.
And what's really interesting about that is that it's sort of trying to meet the industry where it is, right? It's saying we're trying to speak the language that you speak. So you're used to doing risk return. People talk about this concept of risk return and impact. This is trying to help people understand that. So could you create a profit and loss statement that not only includes the financial factors, but the actual environmental or social impact of a company? And that's what this is essentially trying to do. And so an easy way to conceptualize that is thinking about carbon pricing, right? So that's a way to price in what an environmental impact could be. So how do you start to think about in creating similar pricing structures in other things, in workplace safety, ensuring that there isn't child labor in a supply chain, for example? So I'm curious what other solutions, Phyllis. I'm curious if there's other things out there. I know you're in a new job now where you're sort of looking to help design solutions on the social piece of things, because there is a lot more data and I think momentum around the environment of ESG.
Yeah, dare I say we're focused on the S here at Climate Week, but we are. There's not been a lot of work done on the social in ESG. And if we look at the rating agencies, the biggies, the MSCIs, the S&P, Sustainalytics, and you look at the correlation of their rating, the correlation amongst those is 0.54 compared to credit rating agencies at something like 0.95. So they don't agree on what are the right factors we should be looking at. There's tons of bias in there. Whereas, if you look at things that you can quantify, it gets the bias out of it. The S is very contextual. It is incredibly qualitative. Unlike the E, it's really easy to measure how much carbon has been removed from the air. And in social, we won't agree on what the value is to a community by having a company in that community. How do the positive externalities outweigh the negative? I think the impact weighted accounts are a great way to get there because it's going to try to quantify that. I also think so what we're doing is we're actually building a taxonomy just for the S. So we're looking at what are the factors that are both financially important and also socially important that will help drive alpha. And we are doing this in a way that will enable us to build funds. So let's say we have a client who's really interested in human rights issues. We can put together a fund with companies that are focused, that have a really good supply chain management process. They make sure there's no violations in their human rights violations in their supply chains, et cetera. So I think getting more people involved in the S and trying to take this very qualitative information and turn it into numbers, as maybe crass as that sounds to many of us in the room, that is the only way we're going to get investors to start looking at that and taking it seriously.
Greg, I'm curious your thoughts about sort of verification. I know you guys are doing some interesting work with SAP, for example, to help them sort of quantify and understand their sustainability portfolio and reporting. So I'd love for you to tell us a little bit about that and how how the system can sort of work better, and that verification piece, which is really important, because can you trust what the reporting says?
Yeah, I mean, I was thinking about this with the previous panel: trust, but verify. And so I think verification is becoming increasingly common, relied upon. It's becoming more efficient. You don't have to pay a firm $100,000 to do a verification. And I think from our perspective, we're looking both from the supply side of the marketplace that we're building. So we're building an impact marketplace that measures, values, and verifies net positive impact in a way that creates a unique digital assets that nonprofits and social enterprise can actually exchange in a marketplace that adds value to corporations, to foundations, and comes with a very specific impact claim that's economically valued, independently verified. And so I think the verification side is building trust and credibility. And so it has to be a part of everything we do. It's not, we're not taking someone's word for it, trust, but verify that. And I think corporations in particular, they don't want to be fined in their annual sustainability reports, and you're seeing increasing cases of that. And so, but they have downward pressure with regulation, upward pressure from stakeholders and consumers to demonstrate how they're making the world a better place. And they're not going to be confident in putting that in their annual sustainability report without independent verification and clear measurement of that.
So there's momentum being sort of pushed by the regulation there. Unfortunately, we are out of time, but there's a lot more. And these are issues that I write a lot about at Devex, including in our Devex Invested newsletter. So if you want to hear more sort of about how impact investing in this development finance space is evolving, tune in Tuesdays.
Thank you.
Thank you, guys.
Thank you.